Hello, I'm Julie Price, and welcome to Juniper's first quarter 2021 economic review. After one of the most extraordinary and difficult years in modern history, we're all hoping for a better 2021, and there are good reasons for optimism. Multiple vaccines have been approved. Granted, new strains have led to a heightened need for faster vaccine rollout, but as they are distributed later this year, the pandemic should finally draw to an end. And after a very difficult winter, the U.S. should re-accelerate in the second half of 2021 as many shuttered service sector businesses are able to reopen. While the elections of 2020 didn't end political division in America, it did bring more clarity as to the direction of policy. And both fiscal and monetary policy are continuing to support economic recovery and financial markets. Despite these positives, many uncertainties remain about the extent and duration of further fiscal and monetary support, the pace of the global economic recovery, and appropriate valuations, particularly in the U.S. fixed income and equity markets following a strong year for investment portfolios. This quarter, we're going to be reviewing 2020 and looking ahead to the strengths and challenges for the economy and markets in 2021. We'll delve into some important topics such as the status of the federal budget, unemployment, and inflation. And what's up with fixed income? I'm going to help you understand the interest rate risk inherent in bonds now that rates have nowhere to go but up. The massive fiscal and monetary support are projected to help the U.S. be a leader in the global economy in 2021. Now it's crucial that leaders be disciplined to repay the debt before inflation takes hold, but they can spend more with rates as cheap as they are right now. Over the next few years, economic growth in the U.S. is expected to be slower than international growth, suggesting a weaker dollar going forward. This makes investments in other countries appear more attractive. So I'll be discussing the topic in more detail. Finally, I discuss the business cycle and what industries follow the cycle, called cyclical, and companies that are defensive or non-cyclical. This is important to understand, and I'll show you why we see 2021 shaping up to look like a good year for cyclicals after being hit so hard in 2020. I try to discuss topics at all levels of financial savviness, but I really encourage you to reach out to me so that we can discuss the concepts presented in the video and how they apply to your portfolio and investment goals. Join me while I discuss these topics and more using the materials from the experts at J.P. Morgan. The Matrix as of December 31st, 2020. It's a great summary of how the asset classes ended up for 2020. As the vaccine started rolling out in November, markets around the world started re-energizing. At the end of the third quarter, U.S. small cap equity was down 8.7% for the year. And within 3 months, it is now the leading asset class for 2020 with a return of 20%. Emerging markets led by China next at 18.7%, coming back from being down about 1% last quarter to date. Large cap U.S. equity at 18.4%, up from 5.6% last quarter. The asset allocation mix up 10.6% after being flat last quarter. Developed markets 8.3%, recovering from being down 6.1%. Fixed income up 7.5%, high yield up 7%, cash 0.5%, commodities down 3.1%, recovering from being down 12.1%. And finally, real estate finishing the year down by 5% after recovering from being down 12.3% last quarter. An extraordinary year indeed. Here we use the S&P 500 to illustrate the last 3 market cycles in the beginning of the fourth. It ran up 100% the first 2 cycles, but this last cycle it increased 400%, dropped 34% at the trough, and is up a remarkable 68% from that point to year end. The PE ratio is still way up at 22.3 times earnings. That means it takes on average 22 years to receive enough dividends to pay for the price of the stock. We'll continue to monitor the PE, but this may be the new normal. This slide does a really good job illustrating the recent growth of the largest 10 U.S. stocks in the S&P 500. Currently, they are Apple, Microsoft, Amazon, Facebook, Tesla, Alphabet, which is Google, Berkshire Hathaway, Johnson & Johnson, JP Morgan, and Visa. Looking back to 20 years ago, in 2000, who were the biggest companies? Exxon was the largest, followed by Pfizer and Citigroup. There were only 3 tech companies, Cisco, Microsoft, and Intel, and a little financial firm called AIG, who the U.S. bailed out in 2008. We didn't see this type of extreme valuation in the great financial crisis of 2008 or the pandemic recession, but we do see a significant escalation building up prior to the tech bubble that burst in 2000. We started to see another escalation begin to build in 2016, but it really started to spike after the pandemic recession hit, which really goes to show you just how different these recessions were. This slide summarizes the sector returns for 2020. Not surprisingly, online retail was the leader at 69%, with information technology close behind at 44%. Home improvement, groceries, and healthcare sound a little bit like the things you spent money on last year. Industrial REITs did not suffer from social distancing like office, residential, and retail real estate. We're expecting a big comeback in 2021 for travel and entertainment. So looking forward for improvements from energy, airlines, hotels, resorts, and cruise lines. And we're already seeing a nice jump in financials the first few weeks in January. But look at this spread. One sector up 69% all the way to a sector down 34%. I love this chart because it shows the very lowest point in 2020 down 34% compared to how it actually ended up the year, which was a gain of 16%. 2020 had a spread of 50%, by far the largest spread in the 40 years shown, a reminder of how much and how fast markets can move. We saw the U.S.'s largest GDP decrease in the second quarter, down 31.4%, and third quarter saw a surge of 33.4%. Now that is not enough to get us back onto this 2.5% trend line that we maintained up until the fourth quarter of 2019. So what is a business cycle? There are 4 stages to a business cycle, which starts with expansion, then a peak, a contraction, and a trough. We saw a well-defined peak in February 2020 and 2 negative quarters of GDP growth in the first and second quarters of 2020. The third and fourth quarters were positive, and we expect the next several quarters to be positive as well. As the new expansionary cycle emerges, we'll go through another expansion, peak, contraction, and trough to mark the next recession. Here's yet another look at GDP. The Conference Board estimates that GDP will reach its pre-pandemic level by April with their upside forecast and by October with their base forecast. So a plunge, a surge, and then a crawl back to normalcy for the economy. Although we've seen recovery in the markets, it takes much longer for the economy to recover. The total federal budget for 2021 is $5.1 trillion compared to $4.6 trillion last year. Most of the budget is similar to last year with the same increase in spending in Medicare, Medicaid, and Social Security. Defense decreased from 15% to 14%. Non-defense discretionary spending increased from 15% to 17%. Net interest, now this is the interest the government pays on treasuries, it decreased from 8% to 6% of the budget. So how do we pay for all of that? Let's look at our income sources. We have personal income tax revenue of 31%, down from 39% last year. Corporate tax revenue is expected to be bringing in 2% of revenues, down from 5% in 2020. The biggest part of the story is the amount of borrowing, up from $1 trillion and 22% of the budget to $1.8 trillion and 36% of the budget. So we're spending at 500 billion more and borrowing 800 billion more in 2021. Over here, we can see the record-breaking budget deficit of 15.2% in 2020, with 2021 forecasted at 8% and tapering off. I'll continue to monitor the federal budget as the latest stimulus figures are added and the 2021 budget is approved. Does this shape look familiar? This is just like what we saw a few slides ago for GDP, but this time it's measuring employment. So here we were right before the pandemic, and we see the decline in payrolls as the start of the pandemic temporarily erased all job gains over the last 10 years. Although there had been a sharp recovery so far, recovery from here out is expected to be slower. Over here, you can see the leisure and hospitality workers are the biggest unemployed group of people, and the industry may not fully recover until many more people are vaccinated. Education and health services, professional and business services, and government have been hit pretty hard too. Still in Washington state, there are people that haven't received any unemployment benefits to date. This is a new slide from JP Morgan. So here we have 4 scenarios, 2 with high inflation and 2 with low inflation. Add to it a rising inflation scenario and one with the falling inflation scenario. In 2020, we were in a low and falling inflation environment. The chart shows that the highest performers historically have been equities, growth, value, and small cap. Commodities suffered. Going forward, we are more likely to be in a low and eventually rising inflation environment, in which case areas like emerging market equities, REITs, commodities, and gold can help boost portfolios historically. Let's not forget about oil. The cause of the recession was more than just the pandemic. The world had an enormous glut of oil that happened to coincide with the time when all types of transportation ground to a halt. It recovered from its initial blow, but it's still pretty low historically. We were just looking at the 10 largest stocks back in 2000. Exxon was the largest company back then, and now there's not one oil company in the 10 largest stocks. Fast forward to the end of 2020, we see that oil has been starting to rise with the hope that the pandemic will start to taper off with vaccinations happening around the globe. So what is the deal with bonds? I'm going to take some time this quarter to discuss fixed income and the interest rate risk that is inherent to them. The yield of a bond is calculated by taking the income, which comes in the form of interest, divided by the current price. So if you're expecting to receive $2 worth of income a year on a $100 investment, then $2 divided by $100 gives you a yield of 2%. Bonds are inversely related to interest rates. So when the Fed funds rate falls, bond prices increase, and the opposite when they rise. This chart shows just how much bond yields fell in 2020 as the Fed slashed interest rates to zero. The 2-year Treasury yield fell from 1.58% to 0.13%. Yields fell about 1% for 10-year Treasuries and investment-grade corporates. Pretty brutal. In every sector, yields decreased. The value of a bond is found in its yield, not necessarily its market value. It may be temporarily up in 2020, but when interest rates rise, prices will fall. So at the end of the day, a bond is only worth how much income it produces relative to its value. Now, when we look at performance, which includes the price and the reinvested interest, bonds performed very well last year. The AG in the 5-year up over 7%, TIPS in the 10-year up almost 11%, the 30-year at almost 19% for the year. All areas of fixed income did well from a performance basis, mainly because of the decrease in the federal funds rate, the rate banks charge for overnight lending to other member banks. But now with rates at zero, they have nowhere to go but up. The Fed says that they're not raising rates until they see a sustained 2% inflation, so it will probably be a couple years before we see the effect over here, the impact of a 1% rise in interest rates. Let me explain this. In a mutual fund of 2-year treasuries, you would have bonds maturing in 2-year terms. So you're constantly replenishing it with newer bonds that have been recently issued with current interest rates. So you don't have to wait as long for higher interest rate bonds to find their way into the fund. In long-term U.S. treasuries, you have 20 and 30-year treasuries at various points of maturities, and you can wait up to 30 years for the longest bonds to mature before they're replaced with newer bonds. So the longer the term of the bond, the greater the interest rate risk. We saw the Fed funds rate decrease 1% in 2020. Now the change happened partway into the year in March, but the math it gives us is the opposite result to a 1% rise in interest rates. Here we see that treasuries have a projected decrease of 2%. In 2020, it was up 3%. 5-year U.S. treasuries with a total return projected to be down 5% for the year, and they increased 7% last year. The 10-year down 9% and up 10% over here, and the 30-year down 19% for the total return projected up 19% in 2020. Bonds are different than stocks in that we can better project how they'll perform given the change in interest rates. I wanted to prepare you for a time when interest rates begin to rise again because we would see a decrease in bond market values. So how do we deal with the risk? Most of the portfolios that I build are made up of short to intermediate bonds, investment grade corporates, high yield, municipals, mortgage-backed securities, and asset-backed securities. Aggregate is a combination of most of these sectors. But these are the fixed income sectors that include more of the securities that will be least affected from an increase in interest rates. So I concentrate portfolios in these sectors. This chart breaks out the two components of value found in bonds if yields increase 1%. Interest, the coupon in purple, and the price return, the return of capital, in blue. As bonds draw closer to their maturity date, their price gets closer to par value, the amount the bond was purchased for. But before then, their value is what this chart shows you is what's vulnerable to interest rate risk, which is the blue area. The coupon is guaranteed by contract, so the payment will always be the same. The value of the bond before they mature is determined in secondary markets and is based on the function of what the bond is earning, its coupon rate, and what it could be earning with current rates. Looking at global equity markets, emerging markets was the highest performing region in 2020 with the U.S. just behind it. Like I said earlier, emerging markets did well largely because of China and India, but also Brazil and Russia contributed, but in a lesser way. Russia was up 52% in 2019, so not as painful when you look at them in context. The currency exchange did not help U.S. investors in these three countries, but China and developed nations did get a boost from the currency exchange. 2020 ended up being a pretty strong year for most countries, especially when you add the 2019 returns to the backdrop. 57% of global stock opportunities are located within the United States, which means that 43% is outside of the U.S. Just a reminder the diversification opportunities available. This chart here illustrates different sector exposures across regions. So what is a cyclical company? Earlier, I defined a business cycle, expansion, peak, contraction, and trough. Cyclical companies experience business cycles. They are industries that make or sell products that we can live without or delay buying when times are tough. Firms like restaurants, hotel chains, airlines, furniture, high-end clothing retailers, and automobile manufacturers. Revenues for these firms are generally higher in periods of expansion and lower in periods of contraction. Non-cyclical industries make or sell the basics that we keep on using even when money is tight, like food, utilities, and healthcare. Tech companies are also considered to be cyclical, like the FAANG stocks, FAANG, for Facebook, Apple, Amazon, Netflix, and Alphabet, known as Google. Tech stocks were considered to be more of a defensive bet in the last market cycle that paid off for investors. Look at how the U.S. has so many more tech companies relative to cyclical sectors compared to other regions. Here's another chart that illustrates the difference between U.S. growth and U.S. value in the global equity environment. U.S. growth didn't drop off as much and had a pretty quick and strong recovery compared to other areas. U.S. value is down here with other regions. Value tends to be more cyclical, and they may be an area of growth in 2021, especially with the staggering level of fiscal and monetary response coupled with low inflation and low interest rates. This allows companies to issue more bonds so that they can invest in more business activities. Owning international stocks come with more than just business risk, but also currency risk. If the dollar falls, that means your foreign stocks are worth more once they're converted to our currency. The left side shows how cycles in the US dollar tend to last a few years. This may be a signal that we're in the early innings of a move downward in the dollar. Additionally, it shows how currency movements are closely tied to the differences in growth between US and the rest of the world. Over the next few years, economic growth in the U.S. is expected to be slower than international growth, which suggests a weaker dollar going forward. On the right side, we see the annual returns for the MSCI All-Country World ex-US Index in local currency, which is the return you would receive as an investor in those countries. Then add the currency exchange, which may add like in 2020 and 2017, or detract like 2018 and here. International has been tough to hold at times, but we need to stay invested for the diversification and the hope of the added benefit of capitalizing on the currency exchange and broader access to cyclical companies. Looking at the global PMI numbers, Japan is having a tough time, and we see a little slip by the Euro area, France, Italy, and Spain. And the UK is still reeling from Brexit. By the way, an analyst at JP Morgan feels that the UK has been undervalued because of Brexit and sees opportunities here. Overall, many countries are seeing stronger purchasing of manufacturing inputs in the fourth quarter, a leading economic indicator that suppliers are increasing production. Thank you very much for making it all the way through this quarter's review. As always, please feel free to reach out to me to review this and more.